Good afternoon, traders and investors. Will back here with another one. Hopefully all of you are having a very beautiful weekend so far. And welcome back to another edition of our subscriber request videos, where we go through the comment section and pick out some of the symbols and company names that you guys have asked me to review over the course of the last 2 weeks. Now, guys, in terms of today's video, we have a number of different requests, about 6 requests to be specific. So since we don't have as much as usual, I figured that I should complement this video by giving 6 of my own top picks for stocks that I do believe are in a good dip buying opportunity for the foreseeable future in these current market conditions. So a lot to cover in today's video, guys. Let's jump right into it. And I like to start everything off first by going through the criteria that I look for a long-term investment. Now, in terms of the subscriber request, guys, none of you have specified whether or not it's for a swing trade or for a long-term investment. So I'll give my perspective on both. But just for those of you who are looking to identify good opportunities for long-term investments, here's the criteria that I like to follow. And we'll go through these very, very quickly. So number one, a stock's price is a reflection of future earnings and future cash flows. Always remember that, guys. This means that if you want a stock's price to go up, their future earnings measured by EPS and their future cash flows measured by free cash flow should be going up. That is the only time where Wall Street will be able to give the stock price a bump and where analysts will be able to raise their price targets, right? If the company has improving fundamentals over time. Number two, do not chase the market, guys, ever. Let the market come to you. There's over 500 blue chip stocks in the market right now and over 8,000 stocks total that we can choose from. Suffice to say, there is always an opportunity in the market, so never feel the need to chase something in the event you feel left behind. Now, in terms of the criteria that I look for in long-term investments, guys, number one, crucial, and this is a big one, and it's point number one for a reason. The company needs to have a competitive advantage in its industry, otherwise known as a moat. If you are considering investing in a long-term company, guys, for maybe the next 5, 10, 15, 20 years, you have to be sure, almost with certainty, that the company will be able to perform the same in 5, 10, 15 years as it is performing today. And that only comes if the company has a very good competitive advantage in its industry. If you cannot say what the competitive advantage of a company is in your portfolio, then maybe it just doesn't have the moat that you possibly think it does, and maybe it might get eroded by competition over time, which is why this is such an important point. Number two, the company needs to have a consistently increasing revenue and EPS number. You can take a look at something like this, right? Take a look at Microsoft, for example. If you want to see the graphs in terms of expansion, there's a lot of different websites that obviously show the graphs, right, for revenue and EPS expansion. But if you use TradingView, you can just come down here on the right-hand side, click on this See Forecast button, and then you'll be able to see the annual EPS expansion and annual revenue expansion as well. This is Microsoft. Notice one thing. This is very consistent and very predictable. There is no mishaps in this chart right here. The last thing you want to see is inconsistent EPS growth and inconsistent revenue growth. It just doesn't line up with a long-term stock that has a large competitive advantage and a good growth prospect. You need to see very, very consistent metrics in these two things if you want to see consistent growth over time in the company that you're choosing. Now, number three, the company needs to have consistently increasing free cash flow. The company company may make a lot of money, but does it spend all of its money in things that it may not that it should possibly not spend it on, right? Does it spend it on too many acquisitions? Does it spend it on too much capital expenditure that the company doesn't need, right? That is what we need to see. We need to see high amounts of free cash flow, because free cash flow is a good measure of what the company can return to you as a shareholder in terms of either dividends or share buybacks, which also help increase the share price over time. Now, number four, this is a big one too. The company needs to have high return on capital employed and high returns on invested capital. Usually you want to see these in excess of 15%. What these are, guys, is these are metrics of how well a company can internally leverage the cash that it generates on a year-to-year basis, right? If it has high levels of return on capital employed and return on invested capital, it means that the company is executing perfectly its strategy of delivering high returns for its shareholders by maximizing every single dollar that it makes for investing purposes. Usually you want to see these above 15%. And if you're curious what these numbers are for any given company, just type it into Google, guys. Just go into Google, type in Microsoft ROCE or ROIC. And if you see those above 15%, usually you have found a true gem. Now, number 5, we want to find also companies with relatively low debt. Relatively low debt is very important, guys. It ties into free cash flow, right? If they're using all of their free cash flow to service their debt, well, they can't really return a lot of that capital to you in the form of either dividends or share buybacks. So you want to find companies with manageable levels of debt that isn't getting too out of hand. And now the last point, guys, is this is where the technicals line up. We want to find these very solid companies at very solid support levels. We want to be waiting for them to come to us. Wait for the pullback, wait for them to come into large weekly or monthly support levels. And that is where we may find a very good dip buying opportunities on these legacy companies. So once again, the name of the game, guys, is solid fundamentals and a great technical entry. That is how you know you've probably found a very good winner. So to start things off, guys, let's go through the subscriber requests. And we have Lisust in here asking, hey, can we cover ONTO this weekend? Of course, let's have a look at ONTO right away. So ONTO Innovation, guys, if you don't know what they do, they are part of the semiconductor industry as a whole, and they've obviously benefited here from the NVIDIA effect starting in 2023. You can see that by their clear share price ramp, right? So what do they do actually? Well, they're a quality control and inspection unit for semiconductor chips. They offer a ton of different services, but all you need to know, guys, is they are specialized in looking for defects, whether that's in the actual production capacities of those chips, in the chips themselves, or possibly data analytics as to how to make production facilities for companies like TSMC, Samsung, all of your actual semiconductor manufacturers, right? How to make those companies more efficient and how to have less and less errors in production. So very specialized niche company that we have right here. As I've written down, Samsung and TSMC represent 10% of the revenue of this company each. So obviously this is exposed to some of the larger players in the game. Now, in terms of the fundamentals, guys, the fundamentals of the company are fairly good. As you can see right here, we do have very nice positive net margins in the last couple of years due to the infrastructure ramp of semiconductors, of course. The net margins right now are sitting right above 20%, which is a very healthy net margin number, bringing a lot of money to the bottom line. Let's have a look at their balance sheet and take a look at their debt. As you can see right here, not much debt to speak of and very decent amounts of free cash flow and cash on hand right now. So the balance sheet really gets an A+ rating for me. No debt, healthy free cash flow, and a lot of cash on the balance sheet to weather any storms in the foreseeable future. Now, in terms of their EPS growth and revenue growth, well, you can see that similar to a lot of other semiconductor businesses, it is a cyclical business, right? This graph doesn't look as pretty as the Microsoft chart, but we know that the semiconductor infrastructure build should be very bullish leading into 2025 and 2026. We've heard that from the largest players in the game so far over the last 2 quarterly earnings cycles, whether it's NVIDIA, AMD, TSMC, ASML, AVGO, the list goes on. All of them are saying that demand is through the absolute roof through 2025. So I do not believe this company is going to have any problem in generating excess returns in the market in the future, at least in the next 2 years. So nice EPS ramp here for the next 3 years and nice revenue ramp here for the next 3 years as well, despite it being a relatively cyclical business. As well, a lot of analyst price targets are considerably above the stock, with the midpoint right now being about 261. So the average target is for about 15-20% share appreciation above the current target right now. So I wouldn't say necessarily that this company is cheap right now. Definitely not as cheap as it was on necessarily maybe the Black Monday event. And it is kind of fairly valued right now. I wouldn't say it's expensive. I wouldn't say it's cheap. It's kind of right there in the middle. So in terms of the other fundamentals here, very good revenue growth per year, 15.5%, 27% per year EPS expansion through 2027, which gives them a forward PE for the end of 2024 at $215 of about 41.2. At a first glance, that may seem like a little bit of a high number, but don't forget, they have a very high EPS growth rate, which is why we derive the PEG ratio, the price versus the earnings growth. It gives us a better metric to be able to compare all of these companies amongst each other with a common metric, whether or not we're paying expensive or cheap for that growth, right? So I'll remind you, for a PEG ratio, anything under 1 is fantastic, anything between 1 and 2 is okay, and above 2 is where it starts to get quite expensive for an investment purpose. Now, at 1.52, the PEG is fairly good for this company. So the fundamentals of the company are very good, the analyst price targets are above the current stock price right now, and it is in an industry that is obviously favored at the current time. Now, in terms of the technicals, guys, well, as most of the semiconductor industry has reestablished a weekly uptrend, this is no different. This is kind of a mirror image of SMH, right? This is the semiconductor ETF as a whole. So you can see that this company is really following the rest of the industry, not so much doing anything on its own. That being said, guys, we can derive a few levels right here. And the one that really comes to mind is around the $200 psychological mark, right? So this could be an area in the event we pull back into this area. If you are interested in this stock, it could be a decent little area for a swing trade. If we were to revisit that 200 mark, it just gives us a little bit more wiggle room if we're targeting the higher end of the take profit range, which would obviously be 240, and then above to our analyst targets to about 260. So in terms of a long-term investment, guys, I do believe that there are better semiconductor names in the game right now for a long-term investment, like 10, 15 years out, companies with more staying power and companies with more of a competitive advantage and more of a moat to speak of, right? Companies such as ASML, companies such as TSMC, your actual industry leaders in their own respective niches, right? This is a good secondary follow-up company, but it wouldn't be one that I would put in a long-term portfolio. But for a little bit of a swing trade down here from the 200 level, possibly up to the 240, as semiconductors come back into favor, back into the rotational favor in the market, perhaps in the next 1 to 2 months, it could be a fairly interesting play. So thank you very much for Lisustin for recommending us to take a look at ONTO. That's pretty much everything I had for that one. Now, request number 2, Lovebox2468 asking, thanks for sharing. May I request 2 tickers, CFLT and Oddity Tech? Well, moving forward, guys, as I've said in the past, probably only 1 ticker per person, just to be fair to everybody, of course. So if ever I see you guys recommending 2, I'll always take the first one. So let's have a look at CFLT, shall we? So let's pull up this chart right here. Now, Confluent. So Confluent, guys, if you don't know what they do, this is a little bit of a complex one, unless you're a software engineer, which I am personally not, but let's do some analysis nonetheless. I'll try to explain the best way possible what this company does without losing too many folks, right? And keep in mind, I'm not a software engineer, so if I don't have this one pinpoint down to the exact wording that you guys would like, if you are in the industry, please forgive me, my apologies, right? So what they are, they're a software as a service company, and they deal in query optimization for a open source platform called Apache Kafka. Now, Apache Kafka, if you guys don't know what that is, essentially it's a think of it as a messaging system for internal use purposes for companies. I'll explain. I'll give you a real world example, right? Banks use this system a lot, and they used to use it at the banks that I used to work as well. Basically what it does is it's a query sorting system. So when you're a bank, you obviously have a ton of queries coming in per day. Withdrawals, deposits, transfers, all of that stuff, right? Now, how do you optimize for which ones of those messages or queries? How do you optimize for which one you want to take care of first? And then when it is taken care of, how do you then log that into the system, right? There's a ton of data that goes into it. So a lot of these people, what they do is they use Apache Kafka. It's the preferred one for developers to really, optimize for the order of those queries and then log them thereafter. So that's the software that most engineers use. However, it's very cumbersome if you're trying to build something in this platform on itself, which is where this company Confluent comes in. Confluent does a good job of making it easy to read the data that's coming out of the Apache Kafka messaging and query system, and they make it really, really easy to sort the data and make sense of the data. This is the whole purpose behind this company, so that's why I labeled it as query optimization for this back end piece right here. So hopefully that explains it in an easy way to understand, right? Now, in terms of the company's fundamentals, as we can see right here, unfortunately, the company is not yet net margin profitable. As a matter of fact, they are losing money every single year. And even this year, guys, it is not much changed. Even though the net margins are getting a little bit better, they are still net margin negative, as you can see. And one of the things that I wanted to bring your attention to, guys, is they're not slated to be net margin profitable, at least for the next 2 years from what I was reading. So let's take a look at their balance sheet. Number one, as you can see right here, guys, unfortunately, this company doesn't have the best balance sheet, right? The company is only worth about $6.25 billion. They're running about $1.1 billion worth of debt, and they're losing money in terms of free cash flow every quarter. So they are at a net cash burn rate. That being said, they have about a couple quarters left of cash on hand before they perhaps may need to raise more debt or perhaps even issue more shares. That's the drawback with some of these companies. I want to bring your attention as well to the shares outstanding of the company over the last foreseeable past, right? Over the last couple of years. As you can see, share count has been net dilutive. So most of this is from stock-based compensation to management and executives, which is normal for a starting tech company, right? A lot of these tech companies, to kind of preserve capital, rather than paying management and executives very high cash salaries, they would rather pay them in shares and keep their cash for the expansion of the business. But what that does, unfortunately, is it kind of dilutes existing shareholders. So just keep that in mind. The fact that they are currently diluting shareholders and also running out of cash, they may need to do another cash raise either through adding more debt or through issuing more shares as a whole. So a little bit of a dilutive event on that front. Just be careful with that as a whole. Now, moving into their EPS expansion, as we can see, they are going to be net EPS positive coming into 2024 at the end, and also through 2027, this is going to be EPS positive. Now, keep in mind, these are on non-GAAP basis, right? Because they're net margin profitable, they could never be GAAP EPS profitable. So we'll take the non-GAAP numbers right here, which is what a lot of analysts do. So decent EPS expansion over the next couple of years. And also in terms of the revenue expansion, I have nothing bad to say. They are expanding revenue in a fairly decent manner too. That being said, take a look at this. Revenue growth through 2027, about 17% per year. That is good for a company this size, but we'd like to see these numbers a lot higher, right? Usually if you're a fast growing tech company, guys, especially if you're only worth just a couple of $1 billion, for it to be really, really a sweet deal, you need to see this number above 25%. I'd love to see 25, 30% revenue growth for this company. That being said, at 17, it's not bad. It's just not the best that you can possibly find in an up and coming SaaS company. Now, moving on further, they have EPS growth of 30% per year, which is also fairly good too. So let's do the valuation down here. Their PE ratio at 19 is about a 90.5. At a first glance, it does appear a little bit high. Even when we divide it, guys, by their EPS growth rate, we get a PEG ratio of 3.02. So this valuation down here, even down here at the bottom end of this last 2 years worth of a range, the valuation is still very high, guys. And that is my one little red flag with this company. The share price appears cheap because of how the chart looks right now. It appears as though it's crushed. But when you do the valuation, it's not actually that cheap. So that being said, guys, fundamentals on this one are a little bit mixed for me, right? It doesn't really get a very high grade in terms of the fundamentals. The technicals, however, are fairly decent for a little bit of a swing trade entry at this bottoming out zone right there. You can see in terms of the weekly, we're really finding a bottom in the last 2 years worth of a range right here. So the $19 for a swing trade could be a good opportunity. In terms of a long-term investment, guys, for me, probably not, just because I don't believe that this company has a competitive advantage that can really make them 10, 20x over the next possible 5 to 10 years. They have a good product, but I wouldn't say it's an industry-changing product that, will make leaps and bounds in the foreseeable future. Yes, they're used by a lot of the Fortune 500 companies. They are mass adopted, so to speak, but I wouldn't say that it's going to be terrifically hard for other companies, bigger companies, to replicate their business model or maybe even buy this company out as a whole. That being said, the analyst price targets are all above the current share price, which does leave us to believe as well that for the people that have done the actual detailed fundamental analysis and the people that are software engineers working in the industry, they do see some bullish perspective on this company. So that's why I say down here for a little bit of a swing trade, guys, maybe into the higher end of this range, mid 30s, even as high as $40 perhaps. When the small cap rotation comes back in favor, this could be a very decent play, but it remains a little bit of a swing trade for me at most. So thank you very much for sharing that one. Now, moving on further, Crash Test asking, next viewer request vid, can I make a fundamentals technical analysis on CAVA? Of course, let's have a look at CAVA, shall we, right away? So CAVA, guys, As you guys know, fast food chain, right? A bit of a healthier fast food chain, kind of like Chipotle. They operate in kind of the same niche as Chipotle does in terms of the type of fast food that they produce. I'm sure a lot of you have been to CAVA. I have been there myself, and it is a fairly good restaurant to say the least. That being said, that is where the positivity kind of ends for me, because the valuation on this one is getting way, 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 way out of hand, right? I thought Wingstop was expensive, and then I did the valuation on CAVA, and I found that Wingstop actually is significantly cheaper, even though Wingstop has like a 4 PEG ratio right now at these ridiculous levels. CAVA is even worse. So let's take a look at the fundamentals here real quick. So in terms of net margins, they are net margin profitable now. They were not in 2021 or 2022, but 2023 and this year, they are net margin profitable, now bringing in about 8% to the bottom line, and it is expanding in a decent way. As you can see right here, gross margins have been expanding, their operating margins have been expanding too, and now we finally have net margin profitability as well. So congratulations to the company for finally turning a profit on the bottom line. In terms of the fundamentals, guys, as well, in terms of the balance sheet, you can see that it's fairly mixed, right? They are burning some free cash flow every single year here. Over the past one quarter, they are now free cash flow positive, but I wouldn't say it's enough to kind of derive a long-term trend of profitability in terms of free cash flow. And in terms of the balance sheet as well, debt and cash equivalents are kind of on par with each other. So I wouldn't say it's the best balance sheet, but I wouldn't also say that the company has a problem with debt right now. The company does bring in over $720 million in revenue. So they do have enough money to kind of cover that debt in the foreseeable future too. Now, in terms of the forecast for the next coming years, as you can see, very nice EPS expansion over the next 4 years and very nice revenue expansion too. So everything is moving in the right direction for the future for the company. But that is kind of where the bullishness for me stops on the company, right? Take a look at these fundamentals, guys. They are not good. Revenue expansion, 17% per year. That is good. EPS growth through 2027 is very good. 30% per year, guys. That is very, very good, but it's not good enough for the current share price. Look at this. 2024 PE at $123 is 293. Crazy PE ratio, even on a forward basis. And when we divide this by their EPS growth rate of 30% per year, we get a PEG ratio, the highest PEG ratio that I've ever seen while doing these analyses publicly on the channel. The PEG ratio is at a 9.76, guys. Even if this stock would get cut by 66%, it would still be a 3 PEG, which is absolutely ridiculous, which means the fair value of this stock for me at this point has to be all the way down in like the $50 range. It's absolutely crazy. And we have done this analysis with the next 3 to 4 years worth of growth baked in. So it's not as if they can grow their way out of this ridiculous PEG ratio either. So this one, guys, is way, way, way too high for me. Not touching it for a fundamental trade, and also not even interested in it for a type of swing trade. This is one company where if ever there's any somewhat of growth concerns for the company whatsoever, it is going to fall out of the sky very, very quickly. We've seen that with other companies this year. CELH, these things can happen very, very fast, guys, to where a company can lose a tremendous amount of share price value in a quick amount of time. CLH, Elf Beauty, right? These companies, when they run high valuations, it only takes one little touch of a growth concern and the company instantly, over maybe a month or two, can start dropping 50, 60%. And that is the only location where I would buy CAVA. I'm sorry if you guys are in this one as a whole, but this one for me is a sell at the current level. Not financial advice, but if I held it and I woke up to these gains after being asleep on it for the last 6 months, I'd be selling this one so fast, you wouldn't even be able to see me hit the sell button, right? That's how fast I would sell it. And in terms of a swing trade as well, not for me. So apologies for the negativity, guys, but we have to call these as we see them. The valuation for this one is just absolutely ridiculous right now. So hopefully that makes sense for CAVA. Now, number 4, Ant, asking us can we include Generac in one of the reviews, looking into it for a midterm swing trade and wondering if it will ever break out, considering its fall from the all-time high in 2021 and increased demand for generators for installations like data centers in the near future. Absolutely. Let's have a look at Generac. So Generac was actually part of my analysis just about a month ago at this point. We did an in-depth analysis, and the analysis for me is roughly the same. Great company here, guys. If you don't know what they do, it kind of says it in the name, right? They manufacture generators, power generators to be specific, either for household applications or for large commercial and industrial applications too. That being said, they have 70% of the entire market share of that business. So I like them. Competitive advantage, and they do have a moat. They're also in a hot narrative right now with the clean energy and electrification, also with the data center and infrastructure backup power ramp. Obviously, for those data centers, you're going to need some backup power because they cannot afford to go offline. So they will have some tremendous amount of sales pricing power in the next 2-3 years, that's for sure. They are also a highly cyclical business too. A lot of these commercial grade generators, guys, cost $20, $30, $40, $50,000, and a lot of these are put on financing. So now that rates are coming down, it could be a very bullish catalyst for this stock as a whole, looking very, very decent. And the residential and commercial business has a 10% compound annual growth rate. So it's in a growing market to speak of too. In terms of the fundamentals of the business here, guys, fundamentals look fairly good, if I do say so myself. Yes, they had a little bit of a slowdown here, 2022. It led to an inventory buildup, which is now easing. Tremendous amount of share price appreciation during COVID. With all that stimulus money, everybody was spending it on generators too. And then it led to a tremendous inventory buildup when everybody had obviously bought them. And now we've kind of bottomed and leveled out. They've gotten rid of the inventory for the most part. And now we're looking for that second leg of possible expansion with all these bullish catalysts that we've been speaking of. So the company is net margin profitable. They don't bring in a tremendous amount of net margins, right? Only between 5 to 10%, depending on the cyclicality of the business, which is fairly good to speak of. In terms of the balance sheet as well, the balance sheet is not too bad, right? This company does bring in, let's call it over $4 to $5 billion in revenue per year. The debt is only standing at about 1.65. They do bring in a decent amount of free cash flow per year, always between about $300 to $400 million in the last couple of years. And they also have a little bit of cash and cash equivalents. So it's not the best balance sheet, but I don't think there's any major red flags for the company either. That being said, let's have a look at their future growth. Their future growth is fairly good. As we can see, cyclical business, right? Kind of goes up and down with the demand for the service as a whole. I wouldn't say it's as consistent as Microsoft, but EPS expansion slated to be good in the next 4 years. And also revenue expansion said to be good in the next 4 years as well. So that's why I say, guys, this one probably rounding the corner and ready for another expansionary phase. That being said, most analyst price targets are currently around the share price right now. Maximum target is 200. And we have a couple of big time bears down here at 78, but I wouldn't be too surprised, guys, if the stock is able to maintain its current price or move a little bit higher as we lead into some of these more bullish catalysts in the next year or two. That being said, revenue growth is good, 8.4% per year and 19% on EPS growth per year through 2027. Very, very solid. Valuation, 2024 forward PE at 154 bucks is only a 23.5. That's not too bad. When we divide that by their EPS growth rate of 19, which is very good, we get a PEG ratio of 1.24. This is very good, guys. This is relatively cheap for this company, and I would not be opposed for as Ant was asking, right? A midterm swing trade. This is the best way to think about this company as a whole. I do like this one, guys, for a midterm swing trade. It's coming off some of our lower end of our support. I would have preferred finding it lower in the 130 to 120s, but even here, guys, between the 150 and 140 level, I don't believe it's too bad of a bet to be taking with the market right now. Monthly uptrend is now reestablished, and we're really looking to push this forward as this one comes back in favor, recapturing some of the long-term moving averages and coming into possibly this next target up here at about the 200 to 220 level, maybe over the next 4 months, right? 3, 4, 5 months as we move through the winter. This could be a very decent midterm swing trade as we were, as Ant was kind of forecasting here for those purposes. So I like this one, Ant. Thanks very much for bringing up Generac once again. I was actually looking to make some trades on this one myself. Now, moving on forward, Killer Rabbit 2693 here. If you can include SMCI, that would be fab. Of course, got a lot of people asking for SMCI in the most recent weeks with good reason, right? They have been the target of a lot of negative headlines, of course. They delayed their 10K filing, which led to a lawsuit from the Department of Justice. It also led to a short selling report from Hindenburg saying that they're cooking the books, essentially manipulating their accounting to make it look better than it has appeared, and those accounting manipulation allegations go back for the last 3-4 years. So there could be a heavy revision put out by the company. Now, we did have the company CEO about a week and a half ago coming out and saying that the accounting numbers would not be changed or amended that much in the upcoming filing that they're going to make. But still, you kind of have to take all of these pieces of information with a grain of salt, right? That being said, if the accounting is good, this company right now is extremely cheap, especially for a little bit of a swing trade. In terms of a competitive advantage, long-term investment, a moat, I don't think they have it, guys. Keep in mind, this company, all they do is they manufacture server racks. This business can be easily replicated by other companies such as HP Enterprise, Dell, or even NVIDIA themselves if they wanted to, right? It's a very easily replicable business as a whole. That being said, they're coming up on a stock split next week on Tuesday. We have a 10-for-1 stock split. So that could give some investors a good opportunity to maybe pick up some shares at a cheaper share price in the event that they wanted to play some options on this one as well. Good Q3 guidance. I actually like their earnings when they came out with earnings just a short time ago. Good Q3 guidance, and the CEO did say that there's a tremendous amount of demand for not only their current server racks, but also their updated version of their server racks that they're doing, which is the liquid cooling server racks as a whole. They spend a lot of money building capacity for those liquid cooling server racks right there. So in terms of the fundamentals of the business, guys, if the accounting is good, the fundamentals are good as well. Take a look right here. They are net margin profitable. They don't make a tremendous amount of net margin, which leads us to believe, right, that could be a problem. If other competitors enter into this game right now, well, then you guys know what happens, right? More competitors equals more supply, and then possibly people are going to be forced to reduce their prices to compete, and that could erode some of SMCI's very thin margins right now. So that's the one little caveat that I may point out right here. In terms of the balance sheet is not too bad. Only $2.17 billion worth of debt, and cash equivalents is sitting at $1.67 billion. Company's going to bring in over $20 billion in revenue through 2025, which, you know, if they wanted to, if they can generate positive free cash flow, they can probably pay down a lot of this debt, even with their cash outstanding on the balance sheet right now. So the balance sheet is not too bad. In terms of the growth prospects for the company, right? Growth prospects are very good, and the CEO said this on the earnings call just a few short months ago. 25, 26, 27 should be booming, glorious EPS expansion, and also revenue expansion should be very good too. Now, revenue growth through 2027, 22% per year, very solid. And EPS growth, 34% per year, also a very solid number. At $420 right now, guys, the valuation on this one is very cheap, arguably one of the cheapest in the entire semiconductor industry right now. So the forward PE for 2025 is going to be about a 12.5 price to earnings on a forward basis. That is cheap just at a face value number. But when we divide that by their EPS growth rate, we get a PEG ratio of 0.36. And I label this, that is great. Dare I say, amazingly fantastic if the growth is real. If no new competitors enter the space as fast as some people anticipate that they will, and they can maintain this growth rate and maintain their pricing power, they are trading excessively cheap right now as a whole. Even if we cut this growth rate in half, they would be trading at roughly a 0.72 PEG, which is very solid. And even their price to sales, right? A more value-oriented metric is amazing. 2025 price to sales is 0.89. All that means is, look, they're going to be bringing in next year about $28 billion worth of revenue, and their market cap right now is only about $24 billion. So under one price to sales, both of these metrics, the PEG and the price to sales, are amazing. And we're also slightly coming into the last area of support, which starts at about 360 all the way down to this lower area right here, about 310, right? So I would not be opposed. SMCI for me, not a long-term investment. I don't think they have a competitive advantage in the long term. They're just really benefiting from the infrastructure boom over the next 2 years. But if you're looking for a longer-term swing trade, now amidst the height of uncertainty, amidst the height of the lawsuit headlines, the negative sentiment around the brand right now, this is where you would want to build a position for the swing trade, right here, all the way down into the support area below us, 350, 320 at the maximum drawdown location. Could be a very interesting area to start building some of those swing trade positions, because this one will be a case of rising tides lift all ships. We know that semiconductors have been largely flat, right? Since the peak in July, they haven't really done much over the last 2 months. So when this one starts to embark on that next leg of growth, possibly into late 2024 and into 2025, especially, SMCI will probably be getting a lot of that love. And the next price target for me, of course, is going to be in the mid 700s. Let's just do a double check here on analyst price targets. Yeah, for the most part, most of everybody has price targets 700 up to roughly, that one's a bit high, 1300, but let's call it 700 up to 1000 is going to be the metric. So there could be a decent little play here, guys. 50% or maybe at best, possibly even a 2x if semiconductors really have a next nice bullish leg end of 2024 into 2025. And those are my thoughts on SMCI. Now, moving on further, Dave Wedding Films asking, hey, Will, thanks for your videos, much appreciated. Can I get your thoughts on waste management? Looks nice and safe to me, but would love to hear your thoughts. Thank you, Dave. So guys, first thing, if you haven't checked out Dave's, here's his handle right here, Dave Wedding Films. Does great content, guys. He's a videographer and photographer for weddings, of course. I checked out his channel. He's just starting YouTube, so if you can, give him a like, give him a subscribe. Follow his YouTube channel and his Instagram page as well. He's really starting to try and ramp up his social media. I've had a look, guys. His Instagram is beautiful, so show him some love if you would be so kind. So Dave, no problem at all. Let's have a look at waste management for you. So moving on to waste management. Waste management, guys, full disclaimer, this is one of my favorite companies in the stock market, right? I mean, you can argue that there's other ones, right? There's really between Waste Connections, this one and Waste Management are two of your larger companies in the game right now. And they both have kind of the same charts, right? As you can see, very, very steady business over time. Waste Connection is kind of the same, right? Very, very, very stable business over time. And it makes sense, right? They're a very defensive company. What are people going to do? Not have their waste collected? I highly doubt it, right? So this market is very, very consolidated amongst the top 3 players. The Waste Management is one of those players right now, and is a great area of accumulation right now. I've spoken about this one on the channel in the last 2 weeks because I do think it represents a good swing trade opportunity, but also it's a very decent long-term investment, right? It's a boring company that you're very sure that that's going to present very consistent gains over time because it's one of the market leaders in terms of what it does. So that being said, let's have a look at some of the fundamentals right here. Pays a 1.44% dividend, which is quite good. Their net margins have always roughly been the same, always about close to 10% or slightly over net margins. So those are very good. In terms of the financials of the company, well, these companies all run a decent amount of debt, guys, because they constantly have to modernize their equipment, build new warehouses to expand their business, right? It's a very capital intensive business. Warehouses cost a lot of money, and obviously the dump trucks cost a lot of money as well. So that is a lot of the reason why the company uses debt to kind of, modernize their installations and grow the business at the same time. So the debt level is never going to be, you're never going to see these numbers kind of like a growing tech company, right, that has no debt at all. So the balance sheet is not the best, but I wouldn't say it's troublesome for the company. It's always been the case. It's just the type of business model that they operate, right? Free cash flow, however, is fairly decent, and they have a little bit of cash and cash equivalents on the balance sheet too. So the balance sheet is not the best, but as I said, guys, it's really in line with the rest of the industry. If you want to pull up Waste Connections is literally the same, right? Exact same thing. They run a lot more debt than they do generate free cash flow, and from the amount of cash that they have on the balance sheet. So not really a problem for me. It's just the type of business that they operate. Now, moving into the foreseeable future in terms of the growth, as you can see, very nice, consistent EPS expansion, which is what I like to see for a very solid and stable company. Revenue expansion, very decent as well, right? Very boring, very consistent. That is what I like to see for a lot of these longer term investments. Now, moving into the valuation of the company, moving forward, revenue growth, 6.1% per year. That is average with its industry peers. EPS expansion above 10%. That is also what we like to see. In terms of the fundamentals, in terms of the metrics for the valuation right here, well, the forward PE at $205 is about 28.3. Not that high at a first glance. When we divide it by their EPS growth rate, we get a PEG ratio of 2.57. But I've mentioned this before, guys. for more value-oriented companies, this is not a growth company, right? It also pays a dividend. It's just looking to maintain its market share and steadily grow over time, which is why the PEG ratio is not the best metric for this type of company. We could look at the free cash flow yield instead, and at 2.5%, that is fairly decent. It's at the lower end of what I like to look for. Usually I like to look for free cash flow yields between 2.5% to 5%. 5% is obviously the better. You want to see a higher number on this one, but at 2.5, it's not all that bad. And we are coming into a very decent level of technical support right here. So to answer your question, for a long-term investment and for a swing trade in these levels, yes, it's been accumulating in this range ever since the month of February. I do believe it's a very decent buying opportunity for a very stable and defensive company that you could add to a long-term portfolio. I wouldn't make it one of the staples of my portfolio, right? I wouldn't give it the same weighting as, let's say, a Microsoft or whatnot, but I see no problem in adding this one either for a swing trade or for a long-term investment if I was looking to add it into my portfolio. So thanks very much, Dave, for bringing that one up as well. As a matter of fact, as I've shown on the channel in the past week, I have started a position on waste management myself this past week, looking for expansion into the 215 up to about $220 levels over maybe the next 2, 3, 4 weeks type of style of trade, right? So that's pretty much everything in terms of our subscriber requests, guys. Thanks very much for all of your recommendations. Now let's jump into Will's requests or Will's trades, that we have moving forward. So we got 6 companies for you guys. So we're going to start it off with quite a good one as well. The first company we're going to be looking at is CVX Chevron. So we know obviously that the energy trade has not been very popular, especially the oil trade most recently has not been very popular. The last 5 to 6 months, as you can see, the industry has been consolidating a little bit, as the price of oil as well has been consolidating for the last 5-6 months. But oil is coming into a relative bottom, as you can see right here, right? This is the big support level from the last few years in oil, talking about 70 all the way down to roughly $60, $65 in that range. And we're now coming to the bottom of the last 2-3 years worth of trading. The midpoint for the barrel of oil over the course of this year is 75. So I do believe that we're going to have a little bit of mean reversion on oil eventually back to that $75 metric. Now, that being said, guys, that's why most of your oil stocks have been kind of down and not doing much. As you can see, CVX has not really done much here, guys, since even 2022. It's kind of just been accumulating in this very wide range of trading, but good thing for us, it's coming into that crucial level of support down here, talking about this whole 140 all the way down to roughly $130, right? This whole $15 range or $10 range right there is going to be what I'm looking for. Now, this company is a beautiful company, guys. 4.73% dividend, and it is one that Berkshire Hathaway, Warren Buffett, owns himself. It's actually one of his largest holdings. It represents 4.1% of his entire, 5.5% of his entire portfolio right there, and he has a 6.5% stake in the entire company, meaning he owns 6.5% of the entire company so far. It has been one of his longer term investments over the last, 5, 6, 7, 8 years as a whole. So I like this one, guys. Technically, good setup. The company's fundamentals are also fairly good, but keep in mind, it is a very cyclical business and it is tied in heavily to the price of oil. That being said, EPS expansion is not a problem for the company. Good EPS expansion over the next couple of years, and the revenue is going to be maintaining and slightly expanding. As I said, guys, very cyclical business as a whole to speak of, right? But all the analyst price targets, as you can see, are much higher than the current share price for the foreseeable future. So I like this one for a little bit of a swing trade, guys, getting it down here and just waiting, being patient for it, targeting the upside, maybe the higher 165, 170 level. I like oil moving forward, guys. So this is going to be one of the first trades that I'm going to be looking into over the next couple of weeks. Myself personally, I'm already in OXY, as you guys know, but I wouldn't even be opposed to starting a little bit of a position on CVX as well. Now, company number 2, we're going to switch it up now, and I'm going to be giving you guys a beautiful tech name with a tremendously cheap valuation. And this is one that most of you already know. It is Square, 3-in-1 solution, right? It is PayPal. It has a cash app platform, right? Peer-to-peer cash transfers. It is also a company like Affirm. They offer buy now, pay later solutions, which will be very good in a rate cut environment. And they are also a company like SoFi. They offer banking, they offer trading, and they also offer consumer loans. So this company had a problem with profitability in the past, but as we can see right here, they have been net margin profitable now for the last 3 quarters, and Square is guiding to remain net margin profitable for the foreseeable future. The balance sheet as well, no problem at all. A lot more cash on the balance sheet than they do have debt, so debt is not a problem for the company. And look at this expansion, guys. Look at the EPS ramp, right? EPS ramp for the next 3 years, absolutely amazing. Stark contrast from what it was in the last couple of years. And revenue expansion slated to be very steady, very consistent as well, which is why I like this company so much. Look at these revenue and EPS growth numbers. Tremendous EPS expansion right there. And at this current share price right now, I mean, I did the valuation just a few weeks ago at 63, but it's not so far off the price, right? It's about 67 bucks right now. So we can still use these numbers. P ratio is very cheap right now, around a 20. And if you divide this by their massive EPS growth rate, we get a PEG ratio of 0.41. Anything under 1 is cheap, guys. At 0.41, this is like bottom of the barrel for a fast-growing tech company. Not only that, we're in a very large area of support right now. Talking about this lower $60, well, if you want me to zoom in, I'll go on the weekly, right? Talking about the lower 60s all the way down to roughly 55. This whole pocket right here, even right here, guys, I wouldn't be opposed to building a position on Square. As a matter of fact, I now have some leap calls on this one, and we're really looking for some of that price expansion here back into the $100 range. Even if this stock were to double, guys, even if it doubles from here, it would still be trading under a 1 PEG ratio. So keep that in mind. A lot of your analyst price targets as well are between $85 to $100 over the next 1 year's worth of time. Those are all the reasons why I love Square as a tech company right now. It's actually one of my favorite tech plays in the game right now in terms of bang for your buck, right? The risk to reward profile of this company right now definitely deserves a second look. Now, company number 3, this one needs no introduction. It is Google. And I've been talking about this one for a long time on the channel, guys. The last month and a half, I've been mentioning Google is one of the cheapest Mag 7 stocks in the entire Mag 7 list. As a matter of fact, they are the cheapest Mag 7 stock right now. No fundamentals of this business are being challenged right now. Despite all of the Department of Justice lawsuits, I still believe Google has a commanding market share, not only for advertising, but their search business, their YouTube business is going outstanding. Their cloud business is growing extremely well. And the CEO is finally cracking down on excess spending, on excess employee counts, and finally starting to drive shareholder returns, trying to maximize that free cash flow and doing a tremendous amount of buybacks for this company as well. So the company is extremely cheap, guys. I cover this one all the time. The fundamentals of this business are absolutely outstanding. Not much debt. Look at this free cash flow that they generate per year. That is massive. Look at the cash they have on the balance sheet. Absolutely massive. Debt is not a problem. Balance sheet gets an A+ from me. In terms of the growth moving forward, look at the consistency, guys. Extremely consistent EPS growth, extremely consistent revenue growth as well. No problem at all. Has just been in a little bit of a technical sell-off right now. Company is still down about 14-15% from the all-time highs. And I do believe if the markets go into a little bit of a sell-off, a little bit of consolidation for the Qs in the next couple of weeks, if we can find Google back in the lower 160s, 160 down to 150 bucks, this one is a no-brainer buy from me. You saw on the channel, I bought some leap calls down here, and I will not be shy to add any leap calls again if we dip back down under 160, even playing short puts on this, or even if you're looking to build a position for, what the heck just happened? Build a swing trade position. If I lean back too much on my chair, guys, it kind of gets out of position there. My bad, my bad for the noise. So moving into it, guys, if we come down to this location, down near the 200 daily moving average, tremendous buying location for the company. And as I've said before, the valuation right now, even above at 165, is so cheap. Talking about a roughly 1.2 peg right now. Great valuation, great revenue growth and EPS growth for the future. So Google, top tier pick for me. The next company on our list is another somewhat monopolistic company with a huge competitive advantage, and that is Intuit. If you guys don't know what Intuit does, they offer a number of different services, but the one that they're most known for is, of course, their tax software services, but they also have Credit Karma for all the credit inquiries as well, which gives them a very decent amount of business too. So this one, guys, probably needs no introduction for a lot of you. We covered their earnings when they came out with them. They did let 10% of their workforce go recently in the most recent quarter to focus their costs on the ramp of AI, which is going to improve the productivity for their business. They're the industry leader in what they do. Very, very decent net margins as well. Look at this net margin expansion right here, guys, right? Intuit, net margin expansion over the past couple of years. This most recent year has been one of their better ones at about 18%. No problem there. Take a look at the balance sheet as well. Very solid balance sheet. Even though they have about $6.57 billion in debt, the amount of free cash flow they bring in per year, solid. The amount of cash they have on the balance sheet, very solid as well. So the balance sheet gets a very high rating from me too. In terms of their EPS expansion, look, consistent EPS expansion year over year, consistent revenue expansion year over year. This is what I like to see in a very solid growth company. That being said, let's have a look at the valuation right now at $620. We can have a look. So at 619 for the 2025 forward PE, it gets a 32, which is roughly in line with the company's historical average. This one gets a higher valuation from Wall Street just because it's so consistent and so predictable, guys. That being said, if we divide the PE ratio by their EPS growth rate of 15, which is very good, it gets a PEG of 2.13. It's a little bit high, but you would be very hard pressed, guys, to ever find Intuit close to a 1 PEG. It's probably not going to happen. Wall Street gives them a higher valuation, and when they come down below a 2 PEG, usually that's when Wall Street starts doing a lot of heavy buying, and they kind of bid this company back up. That being said as well, we can also take a look at their free cash flow yield. 2.7%, it is okay. It respects the minimum of 2.5. It's not the best deal right now, but I wouldn't say it's a bad deal either. The reason that I like it is because it's been in a big area of accumulation right now, guys. This is a very beautiful area. Look at this support level right here, guys. 620 down to about $600 is the buy zone for me, and we're looking for the expansion back into the higher end of the range. So for a swing trade, 620 down to 600, back up to about 660, 670, I am all for it. But even for a long-term portfolio add, guys, I am all for it as well. This company is now underperforming the SPY. Year to date, it's only down 0.52%. Not even gains for the year. This is uncharacteristic for Intuit, guys. Usually they outperform the S&P on an annual basis, but so far this year they have not expanded that much, which is why I think we are due for a little bit of mean reversion as we come into Q3 and Q4 for the company. I would not be surprised if it plays a little bit of catch up here with the indexes as a whole. So I love this one both for a long-term portfolio and also for a little bit of a swing trade. Now, that was company number 4. Now let's do company number 5 and 6. So company number 5 is going to be ASML, another one of your market leaders in semiconductors, guys. The reason I love this one is because they have an absolute monopoly on what they do. Nobody in the world makes the same machines that ASML does. If you haven't seen their machines, guys, their machines are $200, $400 million machines. If you haven't seen them, look, ASML machines, we'll pull them up real quick. They are EUV lithography machines. The machines are absolutely massive, guys. They're absolutely massive. So many moving parts, so much wiring. It is impossible, dare I say, for competitors to replicate the scale and size of these machines and the complexity involved behind them, right? So they have an absolute monopoly on what they do. And their biggest clients are, of course, these semiconductor manufacturers. These are the machines that build the semiconductor chips, right? So that being said, that's why I love this company. Now, in terms of the fundamentals of the business, guys, fundamentals of the business are absolutely phenomenal. Ever expanding net margins. This company manufactures massive machines. And because they have a monopoly, they have a tremendous amount of pricing power. They can charge almost whatever they want and people will pay. That is the benefit of having a monopoly. So moving on forward, look at this net margin expansion up to 28%. Very good. Take a look at their balance sheet right here. You can see balance sheet, not a problem at all. Only $5.37 billion in debt. A huge amount of free cash flow per year, about $4 or $5 billion per year. It fluctuates. Cash and cash equivalents, about $7 billion. So debt is not a problem for them. Take a look at the forecast right here. EPS expansion, very consistent EPS expansion. Yes, they have a little bit of cyclicality sometimes, but that's true to any business in semiconductors. That whole industry is slightly cyclical, but if you're going to go for a cyclical industry, you may as well, in my humble opinion, go for the market leaders. Now, moving into the revenue also very consistent revenue expansion as well. In terms of the valuation right now, well, my mistake, I didn't redo it at about 841. So let's do that together, shall we? So we're going to do this one for 841. I'll show you guys how I do this real quick. So just to get you guys the updated numbers right here, right? We did it at 816. Let's do it for 2025 end. So moving on to the 2025 end one, 32.71. This was slightly lower, so let's change it real quick. My bad, guys. I thought I updated this. We'll just do it real quick together, right? So we divide their share price, 841 right now, divided by their EPS, which is going to be a P ratio of about 25.7. So let's write that down, 25.7. And then we're going to divide that by their EPS growth rate, which hasn't changed, by about 21.5. It gives them a PEG ratio of 1.2. 1.2 is very, very solid, guys, for a monopolistic company that is still growing EPS at a fantastic rate right now, which is why I love it. I also love it because it's in a great area of technical support. So I like this one here, guys. 841 all the way down to the mid 700s is going to be an area where I'm looking to constantly add shares to my long-term portfolio. I have owned this company now for about the past 4 or 5 years. My first purchase, as a matter of fact, was all the way back in 2019, before COVID even happened. So suffice to say that I'm very happy with my gains on this one, but I continuously add to this company every single month when I dollar cost average into my long-term portfolio. But now this one will get a little bit extra love for me. So I love this one, long-term portfolio, but also for a little bit of a swing trade here, guys, looking to find the monthly lows into support and looking for that monthly expansion when we get the resumption of the semiconductor bullish trade, right? So looking for some expansion back above $1,000. And as you can see, most of all analyst price targets are in that $1,000 range. So looking quite good here for a swing trade and also a long-term investment. And the last company I have for you guys is one that I bring up often on the channel and that has most recently got a lot of love in the past week, which is Louis Vuitton. This one needs no introduction. I'm pretty sure everybody knows about Louis Vuitton, but what you may not know about the company is that it's a conglomerate. It's not just Louis Vuitton. They own 75 different luxury brands, from watch brands, liquor brands, right? Different fashion brands, and also Sephora. They own Sephora as well, one of your leading makeup and cosmetic brands in the entire world. Sephora has the largest commanding market share in the world for a makeup brand right now. So the short-term risk for the company, as I've written down here, low to middle income consumers. Now, even though it's Louis Vuitton, they cater to a more prestige luxury client. They do have a lot of clients. I wouldn't say it's most of their client base, but there's a lot of clients that do shop at their brands, that these clients are low to middle income consumers. And we know those guys have been pulling back, which is why the share price has kind of been struggling a little bit here. They get tied up in that consumer discretionary trade. But if I had one favorite consumer discretionary trade to buy right now, it has to be Louis Vuitton. Not Nike, not Starbucks, not Lululemon, none of that stuff. Louis Vuitton, because they are a conglomerate, guys. They have the moat. They have the competitive advantage that no one else has. So that being said, right now, the revenue growth for the foreseeable future, 6.9%, EPS growth, 10.1% per year. Very good numbers here, guys. In terms of the balance sheet as well, you can see, right, net margin profitable company. This company somehow manages to generate in excess of 15% net margins, despite most of what they do is selling goods. But obviously, they sell goods at premium markups, which is what allows them to protect those net margins, right? A lot of pricing power for this company. In terms of debt, they do a lot of debt because they acquire businesses. They're a conglomerate. They seek to consolidate their dominance across the luxury market and across fashion brands as a whole. So they utilize a lot of debt to purchase a lot of their competitors on the way up, right? That being said, that's just the business model they run. They still bring in a very decent amount of free cash flow per year, and they have a decent amount of cash on the balance sheet. So the balance sheet, not too bad. In terms of the EPS expansion, look, very consistent, except during the pandemic for obvious reasons, right? Very consistent EPS growth and very consistent revenue growth as well for this company. So let's take a look at the valuation right here at $156. I didn't change this right here, but I did change the peg at $156. The 24 PE is pretty much in line with this historical average of the company. It's not cheap, it's not expensive, it's in line. In terms of the PEG ratio, 2.37. But as I say, guys, this one is not so much a growth company as a whole, right? It's a more defensive company. It pays a 1.51% dividend. They're not looking to have exponential growth per year. They're just looking to consolidate their brand power more and more as time moves on. So that being said, 2.37 is high at a first glance, but the PEG is not the best metric for Louis Vuitton. That being said, this is some of the best metrics for Louis Vuitton. The free cash flow yield, guys, is 3.7%. That is very, very, very good, which does lead us to believe that this is a very good buying opportunity for the company. This one is on my list of, well, most of the companies that I just showed you guys, Google, Intuit, ASML, and Louis Vuitton, they are all on my high return on capital employed, high return on invested capital, over 15% per year. The company utilizes internal cash excessively well. I love it down here, guys. I've been buying this one. I've been talking about this one on the channel every single time. It dips into the low, mid to 150s, down to the 140s. It is a buy opportunity for me, adding to the long-term portfolio, but also for a decent swing trade. The recovery story for this one in the last couple of days has been China, because a lot of their business also comes out of China. This has been the reason for the rally over the past week. If we get a little bit of a pullback, guys, I will be adding to the Louis Vuitton position once again in the mid 140 range. But even starting a position here, guys, for a long-term portfolio and adding if we continue to dip here, you know, over the next maybe month or two. We know consumer discretionary stocks are a little bit slow right now. So this is when we need to be building this position in the midst of this now 2-3 year lows. That is going to lead to some very good share price appreciation over the long term for this company. So that's all the companies that I had for you guys today. So thank you very much for watching. Thank you very much also to everybody who recommended some stocks to take a look at. I appreciate you guys for those recommendations, of course. If you enjoyed the video, consider dropping a like. Would really appreciate it for the growth of the channel. Also consider subscribing to the channel if you're new. Would love to see you back. We do these subscriber requests once every 2 weeks type of thing. We also do a bunch of other videos, top 5 options plays every Sunday, and obviously the Monday through Friday stock market recaps after the close. And as well, guys, if you have any questions whatsoever on any of the companies that I described so far in the video, or if you want your stock to be featured in one of the upcoming videos, leave a comment down below and I'll be happy to either answer your question or feature your stock pick in the next subscriber request video. So take care, guys. Been a pleasure as always. Have a great rest of your weekend. See you tomorrow for the top 5 options play video. Take care and peace.